Heavyweights trade soft in sluggish trade, but mid-caps clock some gains. Realty ekes out gains, but metals and energy drag.
Credit growth for the banking sector slows to a 68 fortnight low, even as the deposit growth fails to pick up. Cholamandalam Investment and Finance tells CNBC-TV18 that the commercial vehicle loan business is also seeing a slowdown through segments like affordable housing and loan against properties fare well.
Sami Hotels and Radisson Hotel India tell CNBC-TV18 that November this year has been the best ever, and they expect this run to continue with supply unlikely to catch up with growing demand, at least in the bigger cities.
Bitcoin breaches the $106,000 mark, taking its market cap to near $2.1 trillion. Expectations that a separate strategic reserve will be created by the US under Donald Trump for the crypto assets fuels the move. Good afternoon, you're with us here on Halftime Report on CNBC TV18. I'm Hormuz Fatakia, with me is Mangalam Malu. Before we get to the markets, the big number flashing at the bottom of your screen, the WPI numbers for the month of November at 1.89% compared to 2.36% in the month of November. The food inflation has cooled down month on month but continues to remain on the higher side as well, right? 9% compared to almost 12% last month, but still a cool off on a month-on-month basis nonetheless. The CNBC TV18 poll had projected the figure at 2.3%. Mangalam, good afternoon. The numbers look slightly good on a month-on-month basis.
The numbers look slightly good on a month-on-month basis, but the stickiness of the food inflation is something that we'll most definitely keep an eye out on. Obviously, we do have the November CPI data as well. So WPI is just, slightly lower than what the street was anticipating. 2.3% was the poll. And the numbers come in just shy of that 2% mark. Month on month, it's cooled off from 2.36% to 1.89% as well. What's actually aided this reduction in WPI month on month is fuel and power. That has come down by 5.8%. So there is a disinflation of 5.8% food and power, which is fuel and power. That is down from negative 5.79% in the previous month to about negative 5.8%. We have seen primary articles inflation that has too cooled off from 8.09% in October to about 5%, 5.5% that we're seeing right now. The food inflation, it's still sticky at around 8.92%, compares with around 11.59%. It's shown signs of moderation, but still at a higher level. And then we also have, the core inflation that has come by. So we'll keep an eye out on all these things. We do have Aditi Nair, who's the chief economist at ICRA, joining in now. Aditi, there has been some moderation month on month, but there is still some stickiness when it comes to the food part of inflation. What do you make of these numbers, and what's your view in the very near term?
Thank you. We had actually expected the WPI inflation to come in at around 2% in this month, so it's come in just a tad below what we were expecting. And the broad theme for November was that a favorable base effect was going to pull down the food inflation in this month. Now, looking ahead, there's a couple of things that we need to watch out for. The month-on-month momentum for food items is really quite mixed right now, and we're not going to have such a favorable base effect going ahead. So that's kind of juxtaposed with the fact that, we've got the Kharif arrivals coming in, and overall the Rabi, outlook is looking reasonably favorable at this point in time. So we're hopeful that we're going to end up with a good Rabi crop as well. On commodities, the disinflation is expected to narrow going ahead, and that is something that is going to feed into many parts of the WPI. So that's something to watch out for. And the INR has also been depreciating. So again, that's something that typically transmits a lot faster into the WPI than into the CPI. So that's the other theme that we need to keep an eye on. Overall, for the month of December, we would actually expect that we're going to have a little bit of a reversal. So we're looking at a higher WPI inflation of around 2.5% to 3% for the month of December.
Aditi, good afternoon. Thank you for joining in. Would food inflation be a primary contributor to that reversal? Because month on month, the numbers may have cooled off optically, but they still remain higher, right, at that 9% level. Now, do you see this winter crop coming in and all of these factors contributing to a decline in food prices and then subsequently food inflation, or do you see that number remaining on the higher side again?
So we do expect the YOY food inflation number to remain quite high in December, even though on a month-on-month basis with the winter crop, etc., we do expect to see some amount of softening. But we're not expecting it to be as much as what was the case last year. So between November and December last year, we had a sharper sequential easing, and that's not something that we're expecting this time around, in spite of the fact that some easing which is a typical seasonal, decline would be there. And overall, the trend is also quite mixed across different commodities. So we still need to keep our eye on edible oils, for instance, and even in the vegetable pack, we are looking at a normal seasonal easing in some of the winter vegetables, but for potatoes, onions, and tomatoes, I think we still need to be a little more watchful given the amount of volatility that we've seen in the recent months.
All right, we take that point, Aditi. Just a final question before we let you go. Your view on the RBI policy, when does the first rate cut come in?
So, generally, our view has been that if we get another step down in the CPI inflation to around 5% or so in the next print, which will be the last print that we will have before we go into the February policy meeting, then the likelihood of a rate cut would probably be quite high. So really, how much of a step down can we get between the November and the December CPI inflation reading? That's the main thing that we're watching out for. On the growth side, we won't have another quarterly print, but we will have the advanced estimate for the GDP growth that will be available in January. And our sense is that Q2 was probably the bottom for the GDP growth. We do expect to see higher numbers for Q3 and Q4. So mainly, the decision will rest upon what is the kind of downtrend we see in the CPI inflation. And do we see more confirmation that that path down to 4% that we had seen outlined by the MPC in the December policy review? Are there any fresh risks that seem to upset that disinflation down to 4%? Or does the December print suggest that, we're on track to meet that?
A little early to talk about, this, but even the budget, right? We have Feb 1, the union budget. What would be the policies from the fiscal end is something we'll keep an eye out on, especially given the slowdown that we've seen in GDP growth. Would you be worried about that?
So a few things that we'll be looking out for in the budget for the monetary policy cues. One, of course, do we get that 4.5% fiscal deficit target for next year that we're expecting? Of course, what is the revised estimate for this year, and then how much further correction in the fiscal deficit is envisioned by the government for FY26? What are the medium-term cues as well? Because we are looking forward now to the fresh medium-term path, which was suggested by the government in the last budget, that they're going to move to looking at debt to GDP instead of fiscal deficit to GDP as the indicator for the fresh medium term. So more details around how that is expected. And then for FY26 itself, within the overall fiscal deficit target, what kind of expenditure growth are we looking at? What is the quality of expenditure? For instance, this year, the sense we have is that CapEx is going to undershoot the target, maybe by as much as 1 trillion, because the early trends that we have up to the last month are not suggesting that there was a very sharp upturn, in CapEx after July. So if you recall, in the first quarter, because of the elections, CapEx was moving quite slowly. We got a big surge in July, and then the momentum has varied quite a lot in the subsequent 3 months. But of course, the last month for which we have data is October, which was the Diwali month. So how much of a big push are we going to get between November and March? We are expecting the YOY growth to be very high, but we still think that CapEx will fall short of Government of India's target for FY25. So on top of that, what kind of a YOY growth are we looking at for FY26? That will also be important both to understand the fiscal impulse for growth and the overall quality of expenditure.
All right, Aditi, thank you so much for sparing time and joining us to decode the WPI numbers and the road ahead as well. That is Aditi Nair of ICRA, the November WPI at 1.89% below the CNBC-TV18 poll. Before we slip into a break, it's time for Growth Code, an initiative by Grow and CNBC-TV18 designed to provide you with valuable trading strategies. This week, CNBC-TV18's Nigel D'Souza sat down with Vishal Mehta, CMTN founder at Market Scanner, to understand the importance of a well-defined strategy or edge.
Why is it crucial for traders to have a well-defined strategy? Also, what are the risks one should consider before entering into the market?
A lot of people think that to get into a trading, you just need a demat account and money in your account, right? When it comes to business or even if professions, right? If you want to become a doctor, you spend about 15 years to study and master it. Engineer, the most important thing in like any business is you have to have a strategy and you have to have a capital. We as a retail trader are playing against some of the largest corporates who are with the best of the minds, best of the execution capabilities. So what is at our end is this strategy, because without a strategy, you are in the jungle and ready to be killed.
Now back with us here on halftime report. 160 points down now on the Nifty, almost 600 points down on the Sensex as we speak, down to the lowest point of the day. And considering the kind of recovery that we saw during Friday's trading session, some bit of profit booking coming in at higher levels. What's not doing well on the index though are stocks like Titan, BPCL, Tech Mahindra. Actually, IT is a sector that is not doing well in today's session. Both Tech Mahindra, TCS are leading the losses on the index. Among some of the PSUs as well, ONGC, NTPC also trading with losses of anywhere between 1 to 2%.
All right, so we'll talk about all of this. One of the things that we need to watch out for is Reliance in today's trading session. It's down about 21% from its 52-week high. Has been a bit of an underperformer. It's a fair amount of period for this stock to actually underperform. Typically known, to lead the index on the way up, given its weight on the frontline indices, has a lot of drivers. Let's see, what the view on Reliance from the market is. We do have Parag Thakkar, who's the senior fund manager, Fort Capital, joining us now in the studio. Parag, a pleasure speaking with you. Let's dive straight into Reliance. I mean, what exactly is happening out here?
Yeah. So basically, I will tell you, first of all, the disclaimer that we own Reliance in our portfolios.
Okay.
And I'm thumping the table buy on Reliance. I have.
Okay.
Because one, the earning has bottomed out. I think Q2, where we saw EBITDA of around 38 to 39,000 crore, I think that was a bottom. From here, refining margins have recovered. The full benefit of tariff hike will come in from Q3. So all this will result in EBITDA going up from 39,000 crore average, which we have seen in last 2 quarters, to say above 40 to 43,000 crores. So there will be a 9 to 10% QoQ EBITDA improvement. The other point which I would like to say is that due to the necessity of the industry, the tariff hikes will continue to happen. And Jio has become a big business at 195 rupees ARPU and 47 crore subscribers. It is making 70,000 crore EBITDA. And 15% tariff hike is something which you can build in, which will drive EPS growth of at least 12 to 15% for Reliance in next 2 to 3 years. And even in AGM, Chairman has said that by the end of decade, that is 2030, Reliance will be more than double its size today. So if you see, for example, and this is my favorite thing, which I would like to share, that today Reliance market cap is around 17,20,000 crores. And it makes a cash profit of 1,35,000 crores. So around 8% cash flow yield, OCF yield, after paying interest, you are getting today. So it's a fantastic entry point. Your CSEC is at 6.8. You are getting 8% cash flow yield. It is not free cash flow, OCF yield. And this is going to grow at 12 to 15%. And if you give me opportunity, I'll just tell there are 3 misconceptions about Reliance today in the market. One is that Starlink fear, right? Now, there is a AT&T presentation available which shows that Starlink has only 40 lakh subscribers in 100 countries, while Reliance in India has 47 crore subscribers. Okay, so it is hard for me to believe that Starlink can disrupt Reliance, or I would say any telecom player in India. Second misconception about Reliance, there is high debt. So everybody, if you ask to retail people, they'll always say that Reliance is very high debt. I would like to set it correct. Reliance EBITDA last year was 1,65,000 crores and net debt was 1,16,000 crores. So net debt to EBITDA is below 1x. Even last quarter, when they reported EBITDA of 39,000 crore, when refining was at down cycle, full benefits of tariff hike were not there and retail was sluggish. Right? That time they did 39,000 crore EBITDA and net interest cost, other income, so interest cost less other income, was only 1,200 crores. So their net interest cost is just less than 5% of the EBITDA. So I would like to remove this particular thing from retail people's mind, that Reliance is very highly debted. Right? Third point which I would like to say is that when people say that Reliance ROE is always 10%, 11%, right? So why we should give it above book value? Now here is my point, that when Reliance was investing in Jio, and they invested around 4 lakh crores, if I am not wrong, and today it is going to get a value of 9 lakh crores. They invested around 1.5 to 2 lakh crore in retail. Today they are getting value of 8 to 9 lakh crores. So in Reliance, they invest in futuristic businesses, which the value for shareholder gets unlocked in long term. So to see Reliance on current ROE or current free cash flow is actually a myth.
So, you're mentioning that there will be an EBITDA improvement on a sequential basis, right? What are the factors that will contribute? Will it be the O2C business? Will it be Jio, retail, or a combination of everything?
So I'll tell you, first the full benefit of tariff hike, right, which happened. Because in last quarter it was not a full benefit. Second, refining margins have improved significantly from the bottom. Even today, I just got a message that today it has touched Singapore GRM is at above $6. And remember, these great companies do great things, right, in the bottom of the cycle. So they did this Russia deal.
Got it.
In my view, if $1 improvement in Singapore GRM happens, EBITDA goes up by 4,500 crores. And Russia has various varieties of oil to offer, which will improve Reliance O2C business EBITDA significantly.
So we understand the point on Reliance. Finally, before we let you go, slightly short on time, are there any other themes that what's your view on the market?
So basically my view is that from here on, the Indian economy has bottomed out.
Okay.
So stock market might have seen some rally because of from 23,300, now we are at 24,700 Nifty. So some part of that is captured, but I would say that from here on, government spending will recover. Rural consumption will come back because of good monsoon, and there were late mandi arrivals. So that benefit will also come. So I think apart from Reliance, of course, banking, financials, cement, everybody will see benefit, or say L&T kind of companies. And here I am not talking about price points. I am just talking about the direction of the economy.
All right, Parag, thank you so much for spending time joining us on the show today on Reliance, and of course the themes that he's watching out for going forward. Time for a short break here, more on the markets, and of course the FNO update at midday. Stay tuned, back on the other side.
Welcome back. You're watching us here on Halftime Report. The Nifty is seeing a bit of a slippage right now as we speak, so perfect time to get you an update coming in from the F&O space at midday itself. What's really standing out, if you look at, the Nifty down almost 140 odd points, we did see a 600-point range on Friday, but now we've seen a bit of a decline. Let's see at what point this decline gets bought into. The reason why I say that is because the broader market's doing a lot better. We have the mid-cap index, which is up about 0.5%. In this, sort of moves on the market or environment in the market, the India VIX has actually taken a sharp surge, almost 10.5% higher, closing in on that 14.5% mark. So we'll keep an eye out on that one too. The broader markets are outperforming. Like we said, the small cap and the mid cap index doing extremely well. And even though the lines are narrower, the green line is still above the red line. So that's something we'll watch out for in the second half of trade as well. The other thing, the real estate stocks, they're doing well. Typically, real estate stocks do a little better when they expect, some sort of rate action. So that's something we'll keep an eye out on. Oberoi Realty, Macrotech Developers, or even if you look at, some of the Bangalore-based players like Prestige Estates and DLF in the north. So it's across the board that we're seeing an up move, not one particular geography. As far as the markets are concerned, the 24,700 call on the Nifty, fairly active for a premium of 150 rupees, telling you levels upwards of 24,850 could face some sort of supply. But what happens at the lower levels is something I'll be very curious to know. Largely because, put writers at 24,400 have unwound their positions as against, the street expecting them to write some puts. And also we have the 24,500 put writers unwinding some of their positions. Now we've seen some writing out here telling you 24,400 could be some bit of support. What are the levels that technically tie in for the Nifty? 24,412. That's the 50-day moving average. And the 100-day moving average on the way up is something that we need to close above beyond Friday as well. So that's something we'll watch out for. Stocks that I'm watching today. Dixon Tech may enter F&O ban given the action that we've seen in the open interest out here. And there are a couple of stocks which may exit F&O ban today. One of them is PVR Inox. The other one is Metropolis Health. So keep an eye out on them.
A day that's belonged to real estate so far. A fantastic year for Dixon Tech and lower levels in focus for the Nifty. Some key takeaways there from Mangalam. Time for a short break. Up next, we connect with Amit Agarwal, the Group CFO at Raymond Lifestyle, to discuss wedding season demand. Stay tuned. We'll be right back. Welcome back. Now, Raymond Lifestyle is in focus. The company is expecting the wedding wear market to grow at a CAGR of 12 to 13%, and they are aiming for almost 300 to 350 crore rupees in revenue over the next 2 to 3 years from its ethnic business. Now, we have Amit Agarwal, the Group CFO at Raymond Lifestyle, who is joining in from the sidelines of the Motilal Oswal India Ideation Conference. Amit, good afternoon. Thank you so much for joining in. We've been talking about this wedding season, right? A wedding happening every second, or maybe more weddings happening every second. So how has the demand for the Ethnics brand look like during the quarter, and what is the road ahead that you see?
So, no, thank you for having me, and the Motilal Ideation Conference is going very well. So let me tell you that what we have been hearing and getting the data from the various 600 cities with our franchisees as well as the EBO stores, the secondary demand is very, very good. And after a hiatus, let's say, of 15-17 months, we are seeing this kind of a wedding season coming back. So what we saw, first there was a big move for the Diwali, and then post that, the wedding season. We are expecting, and the wedding season is not just happening in the month of November, December, rather it is extending up to the month of May. So at this juncture, the shopkeepers, the wholesalers, the franchisee network, everybody is very excited to see this demand growth, and people are coming up. And it is not just the shopping for the bride and the groom family, it is also the people who go and attend these weddings. They are also very excited to shop the products.
All right, we take that point. But, if you could give us a sense of your revenue mix itself. While Raymond does do a fair amount of formal wear, etc., ethnics is something that is growing. I mean, how much would you attribute as the entire wedding season, which includes some purchases of suits, etc., to your annual revenues? If you could give us a sense of, okay, out of 100 that we sell, 40, 45 or 50, etc., comes in from the wedding season, and this is what we're expecting this year and the next. If you could give us that clarity.
Sure. So look, if I look at our business, so it has got the fabrics business, then you have the apparels business, then you have the ethnics business, and then the garmenting and the shirting business. Now, if I look at it, the pure play fabric business, and you know there is a common saying in India, there won't be a wedding in this country unless and until a Raymond suit gets stitched. So we have been in the wedding space not today or yesterday, we have been there, and this is the 100th year for a very long period of time. So we see that the wedding space at our retail value, because you know the whole process is that we sell to our dealer and the dealer under our brand name sells it to the final customer. So if I look at the gross merchandise value from a total wedding estimated market of 75,000 crore wedding menswear, I think we get almost 3,500 to 3,800 crore value which is coming to us. Obviously, our numbers will be lower because we sell it to the dealers who put a markup and then they sell. So we are supposedly the largest player in the wedding segment on an organized basis at ranging around 3, 4, 5% of the total market share because it is loosely defined. Second thing, if you look at the ethnics, you know, we have been continuously on a journey of expanding our stores. We have opened, as we speak today, almost 140 stores in prominent cities, which is actually doing very, very good. Compared to the last year to this year, we have seen a very significant growth in these numbers compared to last year. Because the growth is happening, the weddings are happening, weddings are becoming larger, so that is also reflecting us. And over the next 3 to 4 years, we expect our wedding or ethnic stores to take it to the strength of close to 300, 325. And I think we expect each store when it gets matured over 3-4 years to do anything between 1.5 crore to 2 crores per store.
So what is in the pipeline now for the second half, Amit? What are your expansion plans, new product pipelines, if you could shed more light on those?
Yeah, sure. So the basic saying is, jo dikhta hai wo bikta hai. So you have to have more stores getting opened. And in our line of 300 stores of ethnic expansion, this year again we will add anything between 80 to 90 stores in this year. So in second half would see another 50-60 stores to get added. Second thing, if we talk about the new lines in the fabric side, we have launched the ceremonial collection, which is again very, very closely related to the weddings. Then we have for the formal suits, the Bello Italia range, which is competing with the Italian range, which we have launched. So that is one on this side. On the apparel side, if I look at it, the whole casualization piece which we have launched is doing extremely well for us. And we are launching new products because the summer season is expected to be good. And people are coming for the bookings on the suitings and the shirtings in the next few days. So we will also watch out what kind of bookings we will see. But new collections are continuously being launched by the company.
All right, final question before we let you go, Amit. You know, basis the numbers that you're talking about, 325 stores, 1.5 crore revenue implies that over the next 3 years in the ethnics business itself, your revenues could be anywhere between 350 to 500 odd crores. Well, the growth plan is set for you. The street wants to see some sort of, you know, execution on ground with this plan as well. Because Raymond as a brand has been one of the strongest, like you pointed out, over the last 100 years or so. But, you know, with the strength of the brand, the strength of the business hasn't kept up. So from a 3 to 5 year standpoint, if you could give us a sense of your lifestyle business in terms of revenue target, CAGR, and what is your aspirational margin target? Say 3 to 5 years from now, what are the milestones that the street should be looking at?
Sure, no, very helpful. So look, I'll give you first what we have demonstrated performance. If you see post-COVID, over the last 14 quarters, company has been consistently delivering a growth and has recorded the record revenues and profitability. So that has been one part of the story which is already demonstrated. Now, if I look at it going forward, what we are seeing, considering the mix of all the businesses which we have in the lifestyle business, anything between 12-13% revenue growth and 17-18% EBITDA growth on a CAGR basis over the next 3, 4, 5 years. And that's what we believe is very well achievable.
All right, Amit, thank you so much for sparing time and joining us to discuss your road ahead. Wish you good luck for the conference ahead as well, the management there of Raymond Lifestyle. As we slip into a break, here's some good news for viewers. India's business news leader is now just a click away, and Mangalam is already looking at that click in his CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. And you can download the CNBC TV18 app from the Apple Store or the Google Play Store.
Welcome back. Just keep an eye out on some news coming in. CNBC TV18 exclusive. A whole host of deliberations and discussions are likely to take place at the GST Council meet on December 21st in Jaisalmer. Shivani joins us with what she's picking up on GST on old and used electric vehicles as well as smaller petrol and diesel cars. Shivani.
Well, yes, sources have told CNBC TV18 that electric vehicles or EVs may soon face a higher GST rate in the resale market. The GST Council's Fitment Committee has proposed increasing the tax on old and used EVs and also on smaller cars like sedans from existing 12% to 18%, aligning them with the rates applied to larger petrol and diesel vehicles. Currently, resale EVs fall under this lower slab of 12% GST, while new EVs enjoy a concessional 5% GST rate to promote green mobility in India. But this proposal could make second-hand EVs less affordable for people in India. Now, here's how the current GST structure works. Larger petrol vehicle, diesel cars and SUVs are already taxed at 18%. Smaller vehicles, including compact cars, sedans and EVs, are taxed at 12% when sold in the used market. However, the tax is applied only to the supplier's margin, the difference between the selling price and the purchase price or depreciated value, keeping the overall tax burden low. If the GST Council approves this hike in December meeting, all old and used vehicles, including EVs, would uniformly attract 18% GST. This move could increase cost in the resale market, especially for budget-conscious EV buyers. Back to you.
Shivani, thanks a lot for that. And Timsy is also picking up some other key items that are likely to be discussed on the GST Council's agenda. Timsy, tell us more on those.
Well, that's right. Upcoming GST Council meeting in Jaisalmer on 21st December could discuss some of the major proposals, which includes to consider closure of GOM on revenue analysis, which has been in existence since 2019 and it has not been able to give any concrete recommendations. Thus, there's a proposal for a closure. Then comes the GOM on restructuring of compensation cess that is likely to submit a status report and seeking a 3-month extension under the chairmanship of MOS Pankaj Chaudhary. That is most likely to go through. Apart from this, for the Industry Council is likely to discuss and approve rules and procedures of functioning of the appellate tribunals to reduce the legal burden of courts for the industry and for the government. Then comes for online services. The Council could discuss to issue clarity on details of unregistered recipient and declaration of place of supply. Then comes Council could create a provision to grant temporary identification number to those who are not liable for a permanent number, because there's a huge queue of GSTN while people are seeking GSTN and they are not being granted this. So this could ease the burden and allow these people to conduct business smoothly. Apart from that, then comes a concept note is likely to be discussed in the Council for issuing GST registration based on risk assessment. This will give more teeth to the IT backbone, and the deliberations are on granting different categories of registration based on risk profile and thus allowing out ITC benefit also based on the risk profile. So let's see what happens finally when the Council meets on 21st of December.
Take that point, MC. Thanks a lot for that. For now, the market seeing some bit of recovery from the lows, holding on that 24,650 mark, a 100-point cut. What we'll do is take a short break, come back on the other side. Manisha Gupta joins back. She will have with her Sayam Mehta, who's the president at All India Gems and Jewellery Domestic Council. Stay with us. Welcome Welcome back. We were talking about the wedding demand with Raymond. Just pull up CRM Silk Mills, another stock which, gets impacted positively by the wedding season. The stock's up 9% as we speak. And this month itself, it's seen a rally of almost 37%. So we'll keep an eye out on that one. But that's about the equity space. We have with us Manisha Gupta, who joins in now. Manisha, you spent, I guess, a week in Brazil.
Yeah.
There's coffee, there's cocoa, there's a lot of
Sugar,
metal, there's
ethanol,
sugar,
they pioneered
everything.
ethanol.
Yeah. So how was that, and what commodities are you tracking today?
Well, Brazil was a complete learning, Mangalam, and I can tell you, since you were talking about the wedding season, there were quite some honeymooners there, not so many Indians, but yeah, various part of the world there, and that's a place where you have summers right now, so it was an amazing experience. But we are talking about gold right now, because in the Indian markets, with all that wedding season going on, this is yet another theme where we have seen strong buying continuing, especially with the fact that the gold prices have come very strongly off their all-time highs. Joining us then is Sayam Mehra. He's president at All India Gem and Jewellery Domestic Council. Sayam, hi. Thank you for joining us. First of all, on the Indian gold demand, we do understand also, and there have been reports, Sayam, that Indian jewelers are selling gold in the Indian market at a discount. I mean, how far is that true?
No, the thing is that there is no discounts which is there in the market as of now. But the previously the rates of the gold used to be at 94, 95. Now while with One India, One Gold rate coming up, the gold rates have come up to 92 only, which is 22 carat. There is no extra premium which the retailers are charging now. And in spite of the gold rates reducing a little bit, December is generally a month where which the buying of the end consumers is a little less due to the holiday season, people going out for holidays, different mindset for buying. There is also 1 month of lag, which is about from 15th of December to 9th of Jan. There is less buying. As Ashub, it is in the mind of the end consumer. So there is less selling at this time, in spite of many weddings and festivals which have already been passed. The gold have reduced about $100 from its peak. And I think this month itself also, the rates is difficult. It is difficult for the rates to increase because of there is going to be less movement in the European and the US market because of the Christmas and the year ending coming in. But after January, I see a movement also in gold and also in buying after the 12th or 13th of January next year.
Sayam, I was, I came back from Brazil today morning and I was crossing Dubai as an airport, and, everywhere, every gold shop there was putting out and in big banners on how people buying gold on Dubai airports can make use of GST and VAT refund. I mean, I know GJC has been working quite a lot onto this one, but is there any more development there?
So we had a discussion last year also with the FM and the MOS FM, Mr. Pankaj Chaudhary ji, a few days back when I and the team at GJC went and met them. We discussed about the refunds at the airport. We discussed about anything about the custom duty also, how can it be refunded? Because people, the NRIs who have already shifted outside the country, want to buy the jewelry from their family jeweler, but it is becoming impossible for them because of this 9% or 10% charges which a local retailer has to pay, which an end consumer has to pay. So we had got a commitment last year that by this year end or the mid of April next year, there should be some system which should come up, some refunding system at the airport also which can come up. So still we are following up, but there is a little bit more time which they have asked, and we are following it up. Let us see how it goes. The countries like Dubai, Singapore are following this, but in order to get the funds from the NRI and people buying from a local jeweler here, it is the need is that there should be GST refund and there should be custom refund, which also should be there at the airports.
Sayam, when it comes to jewelry, you're a manufacturer. I mean, you sell for India and you export as well. How are you looking at both of these markets as we come towards the end of this year?
No, I think India domestically has been great. The market has been very good. Not only 22 carat, but also 18 carat jewelry has been selling a lot as the gold rates have increasing. In hallmarking, we are getting 9 carat also in the coming months to come. So that even if the gold rates are going to increase to maybe 78, 80,000, and maybe next year ending, we can see 92 to 94,000. Still, there can be a 25% lower caratage. As per hallmarking, we can sell it at a better rates for the end consumers. In the international market, in spite of the gold rate increase, if you go to see the Saudi market, which is cropping up very well, Dubai, wherever you see, go to any gold souk in Dubai or any other places also, you'll see Indian handmade jewelry coming up there. So So you will see that kind of Indian handmade jewelry which is coming up there. And I think by these ways, Indian exports are increasing also year on year when it comes to gold. When it was 5% previously, now it has come to 6 to 7% of the share in the entire 40 billion, 37 to 40 billion of the exports. Indian handmade jewelry of gold is also now increased from 5% to 7% this year.
All right. Take that point, Sayam. Thank you so much for joining in and giving us those views. We'll wrap up on this edition of Halftime Report while Manisha and I discuss her Brazil tour. Take a short break, come back. Market action taken forward by Business Lunch.